Hello, and welcome to today's program. We're going to be talking about financial market volatility, something that has been top of mind for many investors, not just retirement plan participants. But we're going to have a different spin on it today. We're going to talk about how this is impacting your employees and how should they be thinking about their decisions as it relates to their retirement plan, but then also outside. So by way of background, my name is Kristen Kolish. I'm a retirement plan advisor with the Mahoney Group of Raymond James. I know on the line I have some clients, so welcome, as well as some other plan sponsors and prospective clients. So thank you for joining today. We do these programs once a month on various topics of interest, but I am particularly excited about today because I view the topic almost as doing double duty, right? You're here to get smarter so that you can do better for your employees in your organization. But my hope is that you walk away smarter for yourself as an individual and as an investor for your own financial future. I love using the analogy of when we're on a plane and the flight attendant says, don't forget to put your mask on first. I think a lot of us tend to do that. So let this be a good reminder to perhaps make sure that you prioritize your own financial plan and your own financial health. So that's an added bonus of joining today's program. So by way of some logistics and administrative items, this program is eligible for 1 hour of PDC credit through SHRM. You will receive an email from me tomorrow with the code along with a copy of the slides. So feel free to just kind of listen and take it in, knowing that you're going to have this material to refer back to. So my experience as an advisor, I work with employers from a retirement committee standpoint, reviewing investments and plan benchmarking and record keepers and what have you. But myself and my teammates also provide participant education and retirement planning support. So wearing both hats helps us come back to the employer with some interesting feedback. So I'm going to share some best practices, and I'm certainly open for questions if you want to throw them in the Q&A. I will be sharing my contact information in that email tomorrow. So if you'd like to have a one-on-one conversation, happy to do that as well. What I am finding in terms of a trend is that employees are more open to employer support as it relates to financial planning and tools. So that's great because they're taking an interest, but it's a double-edged sword because there are certain things that as the employer, you really don't want to be doing yourself. So we're going to talk through items such as that. I'm actually going to take myself off of video so that you can focus on the visuals on the slide, and then I'll jump back in at the end as we wrap up. So the image here of a roller coaster is a deliberate one. The reason being is that oftentimes as an investor, we feel like we are on a roller coaster. Sometimes we're happy about where we are. Sometimes we're terrified about where we are. However, unlike going on a roller coaster ride, where maybe you wait to get on and you might be terrified the entire time you're on the ride, you know it's going to end, right? It's going to end in the next few minutes, maybe 5 minutes max. The scary thing about investing is you don't know when it's going to end, and you don't know how steep the decline is. So let's talk through this visual. You're going to see it again towards the end of the presentation as I go through some actionable ideas for taking advantage of this volatility. But what I would point out here is that the quote unquote right action to take in the investment world when you're using logic in your brain is often the opposite of what your heart and your emotions want to do. So think about it this way. As an investor, you are a consumer, okay? You're a consumer of a stock or a bond, for instance. Think about any other market where you're a consumer. You want to buy a new car, you want to buy a winter coat. we're looking for sales when we are in those marketplaces. We want to maybe go to the lot on December 25th, knowing they want to make another sale before the end of the year. So we want to buy when prices are low. When it comes to investing, because there's emotional attachment to our own personal financial livelihood, it feels better to be buying when prices are high. So as I look at this visual, as prices go up, we start to feel confident. Your assets that you own are going up. You think you're making the right decision. Perhaps we get a really great run and you're feeling much richer than you had been just a couple of years earlier. Okay, so if prices are high, while our heart feels good, our head should be starting to say, you know what goes up sometimes must go down at some point, right? We don't know when. So as the markets start to cool off and prices go down, it just doesn't feel good. We feel nervous. It feels better for our balances to only go up and up and up. What we know about investing in the stock market is that there is a greater risk-reward trade-off than, let's say, just buying a treasury bond or keeping your money in cash. But risk is upside and downside risk. And over time, and I'm going to share some historical context later in this program, but in about every 3 of 4 years over the last 100 years, the markets have been positive. So that's theoretically been an easier time to be an investor. But once every 4 years, the market goes down. So without additional contributions, the balance that you had in your portfolio could be lower at the end of the year than the beginning. And that just doesn't feel good. Maybe you're at the point now where you're feeling a little desperate. Is there any point to investing if I'm just going to lose money? And then that magnifies, and perhaps we get additional sell-off. And you're thinking to yourself, I can't take this. I can't take this anymore. There's actually an investment term called capitulation. And that's actually usually a very bullish sign. When investors are selling because they can't take anymore, it's a sign that prices are so low that it actually, as this slide informs, could be a great opportunity to make money. So you can see that this roller coaster ride makes it difficult to make sound, rational investment decisions. And I'll tell you, I've been an advisor for almost 25 years. It is harder today to stay the course than it had been in the past because of the pace of information flow. You pick up your phone, you turn on the radio, you turn on your computer, there's news flashes about things that are going on around the globe, and the pace of information is so quick. Now, I am going to suggest to you as an investor, and something that your employees would also benefit from, is that just because there's a news flash doesn't mean it's relevant to you. So this reinforces the importance of doing some homework as a plan participant or as an investor. You need to know where you want to go to feel good about the plan to get there. So we need something to bump up all of this investment noise against to evaluate, do I need to take action? Okay. And this is an example where I truly believe that individual investors in some ways have a benefit over institutional investors. If you're managing a mutual fund or a separate account and your investors say they want money, you got to sell. You don't have a choice. But as an individual investor, theoretically, with control over our cash flow to some extent, we are in the driver's seat. We don't have to respond to the market. Now, that sounds rational, but I know it's not easy to do. So I want you to put on your HR hat for a second and think about how many times an employee, perhaps just a normal course of conversation, could even be a friend at work, a coworker who's become a friend, and is saying, you know, I can't believe what's going on. My 401k is so much lower than it was 6 months ago. I'm thinking about selling. You know, what do you think I should do? And in your profession, you're doing this because you want to help people. Everyone's heart is in the right place. I know this. But out of the gate, I wanted this to be one of the very, very first slides you see. Avoid giving employees investment advice. I know that your voice is very respected and they will listen to you. And as it relates to encouraging sound financial habits like saving more and engaging with a financial plan, all of those are positive reinforcements for you to make. But when it comes time to talk about specific investments or specific choices that they're making with their portfolio, you want to lean on your service providers for additional support, whether it's the advisor that you've hired for your plan that might do education in addition to committee work, or the record keeper or the vendors. They may not give direct advice. They could guide them towards tools to make decisions. Because this is a situation where you don't want to be held to you're held to a fiduciary standard when it comes to if you are in fact, let's say on a retirement committee, when it comes to offering investments. But one of the great things as an employer is that when it comes to defined contribution plans, you're not held liable as long as you follow certain protocols for the investments choices that your employees make. So you don't want to blur the line where you are giving guidance and advice, even if I'm sure it is with the best, very best of intentions. Referring them to educational materials, articles, videos, advisors, that's really the route to go. When I think about today's program, I'm actually going to start by positioning these three challenges that your employees are facing. I'm then going to talk about what the markets are doing today. And this is a lot of the record keepers that provide market volatility education and what to do when the stock market goes down. All of the historical context is very valuable, and I'm going to share that today as well. But I find to engage with someone, to capture their attention, they want a little bit of context. Well, what's going on today? Educate me. Tell me what's going on. So we're going to talk a little bit about that. Then we're going to put what's going on today in historical context. And then we're going to wrap up with what I call the investor playbook, which what are the tools and resources that can help you during difficult market environments. So investors, not just employees, have to decide for their existing portfolios, are they going to make a change? So their existing 401k, an existing brokerage account, let's say you've got 80% in stock and 20% in cash. Are you going to change that allocation? Number one. Are you going to change the specific investments you own? Number two. Okay. A second challenge is how are you going to manage your future investments? Meaning, what is your saving strategy? Are you going to cut the amount that you're contributing to your 401k? Or are you going to view this as an opportunity, if cash flow permits, to increase the amount that you're saving in your 401k? And what does that look like? And then lastly, are you passing the sleep test? Meaning, when you have some time to decompress from work, is your brain, is your emotions getting controlled by your fear of what's going on with your portfolio? At the end of the day, it's this balancing act between emotions and logic. So how are we going to manage and help you and your employees with these three different challenges? Now, in a lot of ways, 401k, 403b investors are dealing from strength because the nature of this type of account actually plays beautifully into market volatility. You're going to see in the investor playbook section, whether you're in a retirement plan or not, a best practice is to use a strategy called dollar cost averaging. That's where you make this an investment of the same dollar amount over time. So what that does is as prices go down, you're actually buying more shares. Well, guess what? That happens automatically with the 401k or 403b. Automatic payroll deductions are your friend during market volatility. And you're paying yourself before you're paying the IRS, which is why the tax advantage savings option is such a benefit. So this is actually a slide that I've used during employee education meetings without the highlights. I highlighted the bullets that I thought are even more impactful during periods of market volatility, and the reason why your retirement plan could be a terrific place for your employees to save. Investment potential. What Albert Einstein said way back when was that the only magic in this world is the power of compounding interest. And he mentioned that a little tongue in cheek, but what compounding does is it allows the growth on your savings to grow, and that has exponential potential. Okay, think about that over time. Let's say you're in your 20s and you invest, $10,000. Well, $10,000 is going to grow, let's say, to $12,000. That additional $2,000 delta is going to also grow. And that over time, it can be monumental if you're putting time on your side. So and the things that I'm going to talk about today, I probably started in the beginning. This is not the hot investment tip program. You're not walking away with, I should buy this investment over this investment. A lot of times these are financial, this is the stuff that it's like the free lunch. What is the free lunch? The free lunch is to own the two biggest strengths an investor has. The first is to understand your time horizon, and the longer it is, the more options you have. The second, and this is arguably a difficult one, is to have patience. Is to have patience with yourself and to allow things to play out. Now, if you are an employer who also offers a match or a profit sharing contribution, those contributions invested at low prices magnifies the potential growth on the overall portfolio. So my suggestion here is to lean into your retirement benefits. And I often find, particularly advisors for sure, but sometimes employers, when the markets are for lack of a better word, crappy, you don't want to be talking about this stuff. Listen, I work harder when markets are bad because I've got to help people keep their saddles in their seat, keep the butts in the seat and stay invested and be a coach and allow for questions and dialogue and considerations. But ultimately, my message to you and to your employees is that we want to make sure that they're doing no harm to themselves. So there's two lenses through which we're going to have this conversation when we get to the investor playbook section. That's how do I do no harm? And then how do I take advantage of opportunities? And depending on your personal risk tolerance, that opportunity conversation, you might not have the stomach for, but let's protect yourself and make sure that you're not taking a step back by taking action preeminently. This is another slide that I've used with participants, and I want to illustrate the difference in experience with those participants that build the portfolios themselves using your investment menu versus those that might take advantage of record keeper planning tools or a default investment like target retirement date funds. So during prior sell-offs, it's been well documented that the activity level, meaning how likely is a participant to make an investment change when the markets get choppy, was much less for someone who was in a target retirement date fund or some type of portfolio management feature than someone who's doing it themselves. And since I've started, in terms of my career, I've tracked cash flows. And inevitably, cash flows out of the investment that is doing poorly into investments that are doing better. So let's go back to my analogy about us being a consumer. That means people are selling at low prices and buying at high prices because they are acting on emotion. So I happened to this week, in preparation of this program, I reached out to some of my record keeping partners and said, what are you seeing, like, with your participants? Are you seeing that participants are taking action? And one major player in the industry did say that the activity level for those who have built the portfolios themselves is much higher than those who are in the target retirement date fund. So this is where making sure, regardless of what's going on in the market, your employees know how to invest with support. They don't necessarily have to build the portfolio themselves. If they've given that thought and if they've have a strategy, then they might feel more confident seeing things play out than making a change and acting to what's going on in the market. So just a little bit of food for thought. How your investment strategy going into market chaos can influence whether or not you're going to feel like you make a change. Okay, so that was a long introductory section. I'm now going to talk market update, putting in historical context, and then wrap up with investor to-dos and takeaways. And spoiler alert, some of the investor takeaways are going to be introspective. You know, the Stephen Covey analogy that you have to have your ladder on the right wall. For you to be a good investor, you need to identify why you're investing. So think about that as I talk a little bit more timely about what's going on in the markets. I sprinkle in some quotes throughout because I think it's meaningful in giving us some context. We cannot control the volatility of the markets. We can control the volatility of our actions. How many times in your life have you said, I can't control XYZ, but I can control my reaction to XYZ, fill in the blank. And the financial markets are no different. So let me put this in some context. And I will say, I truly believe that investors, in some ways, people don't like aging. Well, I will tell you, having experience as an investor is an asset. So if you're getting up there in age, I think your experiences collectively make it easier to be an investor because you've seen more things, you've lived through more things. So here I show you from crisis to crisis. So back in 2020 and just March of this year was the 5-year anniversary of a market significant sell-off. The fastest and most severe sell-off in recent market history was during the COVID pandemic. At that time, my team hosted for our plan participants a webinar, and we do that not when the markets go down all of the time, but if there's something that is noteworthy. So in 2020 and 2022, we did a program earlier this year, is trying to get ahead of a participant's urge to act. So let's arm them with information and then encourage them to have a discussion before they press the button that says sell all my stock. So 2020 was a scary time for a lot of reasons, not just to be an investor. Ironically, because of fiscal support and monetary support, the markets actually ended the year positive. 2021, also a very positive year for stock. As interest rates started to go up, bond prices went down by 1.5%. 2022, that was a doozy of a year. And the reason being is that stocks sold off significantly, which really shouldn't be a surprise. What did I describe before? 1 in every 4 years, you're going to see a negative return. Well, we see here 1 in 5. The tougher part is that bonds were also down. And the reason for that was unprecedented increase in interest rates in a short period of time. interest rates go up, bond prices go down. So now even diversified portfolios, which that's what most advisors suggest that you do, have a diversified portfolio, they still had negative total returns. And that was a scary time to be an investor. But you know what? There is a such thing as recency bias. And we all benefited, many of us, if you were an investor, benefited from growth in 23 and 24. So coming into this year, in many ways, for a lot of people that I speak to, 2022 was a distant memory. You know, as the market started to get choppy this year, a question that I'd encourage investors to think about is, how did your life change in 2022? Did it? Did it inform, did it impact the decisions you made about your family, about your saving? And maybe it did. Maybe for inflation, it certainly cut into maybe our ability to save. But at the end of the day, your portfolio's being down, if you're still working and retains your job, might not have had a significant impact on your financial success. So now, here we are, 2025, and I'm giving you an example here of how volatile the markets have been. So I show you what's the year-to-date return as of April 8th, and then as of April 9th, okay? So as of April 8th, the S&P 500 was down 15% for the year. Well, guess what? April 9th was one of the best returning returns in the stock market as measured by the S&P 500 in decades. And I'm going to show you a slide on that. So we went from being down 15% to being down 7.5%. Stock bonds were up 2%. Okay. At where we stand as of yesterday, the S&P 500 is down 6% and bonds are up by 3%. So that's good information. It's historical context. At the end of the day, what is market risk? So here we define it as the possibility of losing money in an investment. But how often do you hear your employees say, oh, I just lost money in my 401k? And I challenge that premise by saying you only lose money if you sell, right? The portfolio value might be lower, but focus on the column that says the number of shares that you own of each investment. And if you're continuing to contribute, the number of shares you own, regardless of what the market arbitrarily is valuing it at any certain point, the number of shares are increasing. So again, to hit on a timely topic, and I'll tell you the difference between 2020 and 2025 in my experience, from a market perspective, is that yes, the markets were volatile in both years, but this year I'd say probably more so than any time in my career, an investor's response to what's going on in the market is definitely jaded by their political views and whether they feel that we're going in the right direction or the wrong direction. Tariffs are the reason that the investment world has been shaken up and stocks are down. But I'll talk a minute about this and then move on to like the so what factor here. There are risks of increased tariffs globally. This is an evolving, dynamic situation. However, companies have adapted in the past to difficult economic environments. And while the concern is that we're entering a recession, recessions are a normal part of business cycles. So I don't think this necessarily warrants a reason to completely sell out of stock. I'm going to share here a visual, and again, this is very timely, but it compares what the global trade situation looked like in 2020 versus 2024. And going back to 2020, the United States was a larger trading partner than China in most of the global markets. And in 2024, that picture is significantly different. So while I can appreciate that you're going to get whiplash following the news flow and the headlines and the tariff policy that was global, impacting every country on earth, is now getting stepped back, it's tough to keep up. But at the end of the day, what's getting driven, this conversation is getting driven by trading partners. and understanding, well, what are the implications here? And I could honestly replace the word tariff here and say, what are the implications of anything that's going on? At the end of the day, the stock market is going to expand if corporate profitability expands and earnings expand. So after the market today, we've got some big players in the tech space reporting earnings, and that's the lifeblood of where stocks go. But from your employees' perspective and yourself, what's the impact to inflation? What's the impact to our hiring? And I don't want to undermine this. I appreciate that many businesses are slowing their decision-making process when it comes to hiring and capital expenditures and things that go into real business strategy, because the rules of the road today are not known, and that's still playing out. But I'll remind you that here we are in, it's going to be May 1st tomorrow. It's really only been a couple months that this has been the conversation on a global perspective. There's been other periods of sell-off where there's historical context here. I love this analogy here where we compare the financial markets to the weather, which is, it could be rainy and stormy for a day, it could be for a week, it could have a really, really wet quarter or summer. But if you're willing to wait long enough, the conditions ultimately will pass. So when we think about volatility and defining what are the norms, well, it is very quote unquote normal for the stock market to decline by 5 to 10% in any given year. So we, in some ways, were spoiled going into this year over the last 2 years because it seemingly really went up. We define a correction by being down 10 to 20%, and the analogy of the investing universe, bears versus bulls, a bear market is a decline of 20 or more percent. However, sell-offs intra-year are very common, and I think providing employees some context, and perhaps not something to this detail, that they say, you know what, in any given year, the average intra-year decline had been 14%. Okay, 14%. And this is over a 45-year period. However, returns were positive in 34 or 45 years, and you could take many different examples here. So if you were to see for instance, in the year 2000 and let's see, 2020, for instance, at one point we were down 34% for the year. We ended the year up 16% on a price appreciation basis plus the dividends. So the purpose of this slide, the so what factor here, is that declines are normal. Our challenge is to think about, how is this going to impact your personal financial plan? How is it going to impact that? So I love this example. For those who, this is where, again, as we age, it truly can be a benefit in the investing space. I remember almost to the day what I was doing during the years 2008 and 2009, because it was such a challenging time to be an advisor, to be an investor. It was deemed the Great Recession because it was so very severe. Stocks were down nearly 50%. And unlike some of the more recent pullbacks and bear markets, that went on for 18 months. We've been in this for 2 months, 18 months. And there were many of opportunities where investors say, I just can't take this anymore. So this example here illustrates 3 investors' different experiences. One investor, let's say the person who got scared out of the market during the recession. They started with $100,000. They exited during the sell-off, and they kept their money in cash. So they permanently lost 35% of their dollars. Now let's look at someone who exited the market, but then reinvested after a year. Okay, well, fast forward, 25 plus years, they still had a significant rate of return on that $100,000 despite a 50% sell-off early on. The most compelling example was the investor that stayed invested. And these are the illustrations that I feel give participants confidence to kind of stay the course, where despite, and you see here 2020, that gray line, that was a recession, other pullbacks that you lived through. When you zoom out, and I'll show you another illustration in a moment, it really does reinforce having that patience. Now, why is market timing so dangerous? We're gonna skip around a little bit here. If you miss the 10 best days in the market over the last 30 years, your portfolio is less than half than if you stayed fully invested. The 10 best days in 30 years. That's a minute percentage of the total trading days. If you miss the 20 best days, 47%. Okay. There's two reasons why trying to time the market doesn't work. The first is that you need to make two decisions correctly. You need to decide correctly when to get out, but then, and you know what? You might win that one. The more difficult decision is when to get back in. And the second reason why it's so hard to market time is because the best days tend to come in and around the worst days. So this slide does not include 2025. April 9th of 2025 is going to be added to this list as one of the best single market days. And did anyone feel particularly good about the economic prospects in the beginning of April of this year? No. So the best days happen around the worst days. So that's why I do not have a crystal ball. Investors do not have a crystal ball. Staying the course tends to be the way to go. Let me show you here. Again, I said before, when we zoom out, we could see that blips in the market over time are exactly that, even when it feels so severe when you're living in it. So the dot-com crash of the early 2000s, if you were diversified, you were able to grow out of it. But we'll talk more about those tools in a minute. So as we're getting ready to wrap up with the conversations, feel free also to type any questions that you may have in the Q&A in the Zoom chat box, and I'll answer them towards the end. The investor playbook. Warren Buffett famously said, market fluctuations are your friend and not your enemy. Profit from the folly rather than participate in it. So here I come back to that same roller coaster visual. And what are the actionable items that we can take? Well, for one, I'm not going to try to predict if, for instance, small cap is going to outperform large cap or international stocks are going to outperform domestic. Diversification over time is a great risk reducer and helps average out your returns over time. Continuing to contribute, and that's where we started as one of the number one benefits of the 401k and the 403b is the automation. Lean into that. Perhaps challenge yourself to increase the savings because of the market environment, which is a little counterintuitive. You want to lean into your time horizon and lean into your financial plan, which begs a number of questions. So this is a slide that I use with participants as we start on a financial planning fundamentals program. And I ask 3 questions that have nothing to do with the market and quite frankly, have nothing to do with investments. I think part of the fallacy of the way the financial industry treats investing is that we make it all about like this fund versus that fund. And at the end of the day, an investor's experience is determined by their goals and also the amount of risk they take in terms of the allocation they have between growth assets and safe assets or stocks versus bonds and cash. Not whether or not they bought ABC fund versus XYZ fund, but that's not where the marketing dollars go. So we have to bring it back to basics here and ask yourself in this very moment, what are you saving for individually? When does that goal come due? What is the time associated with that cash need? And how much is it going to cost? What, when, how? You could apply that to any of the tiles below as it relates to your retirement. Perhaps you don't have cash reserves. Maybe that's something that's your next right financial decision. Maybe you're saving for college for your children. I'm in that boat where it's managing college savings with retirement savings. Perhaps it's to pay off debt, or maybe you're at a stage where you're about to enter retirement and you're looking at what your retirement income might look like during your lifetime and beyond. This is so important. Have this be a discussion point. Honestly, this and another slide at the end, while it might not be the most interesting from a current event standpoint, because in many ways it's evergreen, it has the ability to be the most impactful if you spend some intellectual capital and conversation thinking about it. What's great about identifying your investment goals is that it actually makes the investment decision easier. And the reason being is that any cash need or goal you have in the next 1 to 2 years likely shouldn't be in stock to begin with. So let's think about what we're not going to invest it in. So let's say you need to buy a car next year. Okay, that should be in cash and CDs and treasuries and something that's not going to lose value. Let's say you are 20 plus years from retirement. Okay, if you have the personal risk tolerance, you might have the ability to have most of your assets allocated to stock. And then for needs that you have between the short term and the long term, it's probably a combination of the two strategies. I do want to share, I often have conversations with investors who are like, you know what, I don't really know. Yeah, at some point I want to retire comfortably. Well, what does that even mean? You want to maintain your lifestyle. You don't know exactly what age, or maybe it's too far away for you to even visualize what that looks like. I'd like to introduce you to a concept that I think many self-help books lead into, which is, what is your anti-goal? So here I talked about identify your goals. What are the things you don't want to have happen? If identifying your goals in a proactive lens is challenging for you. And what do I mean by that? I do not want to be in a position where I have to sell stock going into retirement. Okay, well, that means you need a cash bucket, an operating reserve going there. I do not want my adult children to have to take care of me financially when I'm in retirement. Okay, maybe you should be thinking about long-term care insurance or really saving so that you have a nest egg that'll support any surprise healthcare costs. Think about what you don't want to have happen as much as what you do want to have happen. The diversification word is thrown around so often, the mantra, don't put all your eggs in one basket. Diversification only works if you are rebalancing to your targets. And I want to spend a minute thinking about that, because this is an actionable item for your employees. Many people don't realize that record keepers today, the technology is so much better than it was when I first started out. So even for those investors who fall into the quote unquote do-it-yourself category, after you put in the time and effort to identify what portfolio you want to invest in, you can outsource the rebalancing, usually at no cost, by opting into an auto rebalancing function with the record keeper. And all that means is that on a regular basis, they're going to compare your current portfolio to your target portfolio and then make changes, perhaps sell something that is over your target allocation or buy more of something that is under your target allocation. So that rebalancing functionality, not only does it have the potential to keep the diversification benefits going, but it also systematizes the selling at higher prices and buying at lower prices, which is what I started by saying is very difficult to do from an emotional perspective, but fundamental to a logical and rational investment strategy. So this is an educational opportunity for employees to say, are you taking advantage of automatic rebalancing? That's either using a target date fund or the tools invested in your plan. I also like to use the analogy of managing your finances like you would manage a business, right? You're not coming into work one day and deciding, because of one customer action, you're going to completely change your strategy. Okay. You're going to come in with a disciplined plan. You for sure are going to try to sit on your emotions and make rational decisions. And you want to own your cash flow. So that could be related to the portfolio. You want to know, if, for instance, if a portfolio is paying dividends or income or what have you. But more manageable is, what are your household cash needs? And understanding, what does your budget look like? I spend, for those of you who have been in programs in the past, I spend a lot of time talking about how budgeting gets a bad rap. Reframe it as a permission that you're giving yourself to spend on certain categories, acknowledging that there's a series of trade-offs, and your budget or your permission slip to spend is based on your personal priorities and should be different for everyone. And look at it critically to make sure that your spending is intentional. I often see, and I can, speak from experience, as your income goes up over time, hopefully as your career progresses, it's easy to get into the category of what I'd call income creep, where I'm making a little bit more, I'm spending a little bit more. There's a very famous book that a mentor of mine gave me as I was starting out over 20 years ago, called The Millionaire Next Door. The idea is that it's not your income that drives your financial health. It is your savings habits, your spending habits, and your investing habits. And those are not things that are apparent based on the house you live in, the car you drive, or your spending habits that are outwards, right? The idea that you can accumulate a lot of money by doing some very simple things. They're not easy, but simple things, and making them habitual. So I started out by saying, the concept of do no harm is, we want to encourage employees before they make a rash decision, that they have a conversation with someone, an advisor, a vendor, to understand what they own today and what exactly has changed in 2025 that is going to impact their personal financial plan, not just the economy and the markets, because I truly believe if we give the markets the benefit of time, it's going to work itself out. I'm not saying it's going to be tomorrow, this summer, or even this year. But what has changed that influences your personal plan? And this is where I encourage investors to be selfish. Think about, how does this impact me? Do I need to act? Should I act? So that's the do no harm piece. The second piece, if you have the appetite for it, is, how can I take advantage of this? If I think at some point the markets are going to go back to increasing when earnings increase, then depressed stocks could be an opportunity to either add to stocks from bonds today, or perhaps increase your savings. One of the things that are different today versus in 2020, which is where I started the conversation. In 2020, cash was paying nothing. Interest rates were at all-time lows, near zero. Interest rates over the last 5 years have increased, which can be challenging for investors who are also borrowers, meaning you have debt, whether it be a credit card, mortgage, or what have you. But for savers, higher interest rates is an advantage. And you think about, outside of your 401k, what cash do you have sitting in a bank? make sure that you're earning a rate of return on that money, because bank deposits might not have gone up, but there are investments, whether it's CDs, certificates of deposit, or treasuries, where interest could be, 3%, 4%. I mean, it's not super duper exciting, but certainly higher than zero. So I bring us back to focusing what we get to control. We don't get to control the markets. We get to control our reaction to the markets. We get to control the financial plan that we own. We get to control the risks we take in our portfolio. We get to control how diversified we are. We get to manage expenses low. We get to look at ways to reduce taxes by saving and investing in a smart manner. So change the mindset as you're thinking here. I think a lot of my conversation today applies to you as an individual investor. As you take this back to your participants, if you don't already have education plans, I would ask you to put that as a goal. Here we are, we're entering May, it's the second quarter. It would be great if before the end of the summer, you shared with employees some educational content, or hosted a webinar, having your advisor or your vendor come in to host a webinar, or offer one-on-one meetings. Oftentimes, investors know what the right decision is, but they need someone to validate that. So give them opportunities and tools to have these super important conversations, and just really to shine a light on the importance of focusing on your personal financial health. This is a topic that is more and more prevalent with retirement committees. Yes, of course, they're concerned with managing fiduciary risk and compliance and all of that, but more and more they are recognizing that there is a significant correlation between an individual's financial and mental health, and they want to be a support system. I don't want to get on my soapbox, but we don't do a great job in this country educating children, adults, as it relates to financial decision making. And oftentimes your employees come to you with next to no knowledge, and they have to make some really important decisions that are going to make some significant impact in their financial futures. So introducing educational concepts, laying the foundation, understanding your cash flow, trying to get employees to invest early. That could be done through plan design, automatic enrollment, auto increase. It could be done through education. Most impactfully would be a combination of the two. And the items on this page, the suggested fundamentals to lean into, have nothing to do with stocks going up or down. These are really evergreen themes that you should be looking to promote over time. So I'm going to wrap up with 3 strategies for dealing with market volatility. Focus on what you get to control, identify your time horizon, and lean into automation, rebalancing, saving, investing. And if you take nothing away from today, is the messaging to your employees that they have supports. First, do no harm, then look for opportunities, and try to put this in some context about when and how you're going to be using the portfolio. It's not what happens to you, but how you handle it that matters. Let me look. We have a couple minutes. I do see a question here about international stocks, and maybe we shouldn't be investing in that because of what's going on. It's an interesting question. Believe it or not, the first quarter of this year, foreign stocks outperformed domestic stocks by the largest margin in over 11 years. So I'm going to get into a little bit in the weeds here, but international stocks tend to do well when the US dollar goes down in value, and that's what's happened this year, plus the earnings potential for those firms. So you could try to be tactical. I don't think if you're looking to do that individually, I would follow some guidance there. For your employees, I think the messaging of a strategic allocation is more relevant than a tactical allocation, because again, we've got to be making decisions on when to get in and also when to get out. But that is a good question. How does the markets change anything as it relates to 401k legislation and the administration? Oh, that's an interesting one. So we don't anticipate there being tremendous amount of legislative change that's going to impact plan sponsors. I'm sure you're sick of hearing the phrase Secure 2.0, it was passed years ago and we're still dealing with the implementation. I think that clarity on that is really where the focus is going to be. We have some very important requirements starting the beginning of next year. As hopefully you all know, your employees who make more than 145,000, their catch-up contribution is going to be made in the form of a Roth. So there's a lot of educational opportunities here to make sure that your employees know how they're saving. It's not just where they're investing, but do they want to save after tax or Roth? Almost all plans are going to need to offer Roth. Otherwise, they're not going to be able to offer a catch-up for those in that higher income level. So I don't expect much administrative change here. However, with that said, and I'll end with this comment, you might have seen that the Supreme Court actually ruled on a retirement related topic in just earlier this month. And it was in the case of a prominent college and the 403B and fees. And an important takeaway there was that the Supreme Court said it is not the participants' responsibility to prove that they were charged, that they paid more than they should have for services. It is the sponsor's responsibility and the employer's responsibility to document that it's competitive. So for engaged committees, I really don't think this is warranting a change other than a heightened awareness of how important it is to benchmark your plan's offering. You don't have to offer the cheapest plan, but any fees that flow through plan assets need to be evaluated for value versus cost. So again, this is not a new concept, but the fact that the Supreme Court was willing to hear the case and secondarily ruled in the favor of the participants shows how important your collective jobs are. So if you have any questions on that, feel free to reach out. We appreciate your time. I hope this was valuable to you. Keep doing what you're doing. I know that you're supporting your employees. Take care of yourself, and please reach out with any questions. Have a great rest of the week.